All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. I'm going to give it a second here for a thumbs up. Make sure we're going through okay here. All right, thumbs up achieved. There we go. All right, market. Been off and rolling here today. It's kind of sitting, near where it traded most of overnight during the European session, which is well off its highs and off its lows by about 10 points here. So, we definitely have a more rangy market that is going on and happening right here. Let's start off with the challenge. We are in cash for the challenge. There are no new signals on the board. That said, the crossover list is a little different than this morning. The only thing we have on the downside crossover list is Intel. Barrick Gold no longer has the cross down. It has a little rally, here on it that kind of erases that. And then on the upside list, this was a pretty big list this morning, about an hour and a half after the market opened. But has been cut down in a big way. Only Ford and Disney on this list now. You can see the price action in Ford. It's still way off its highs. And this is a stock that does have earnings tomorrow. And then Disney. I'd love to play Disney. I'd love the chart pattern here. Beautiful little chart pattern here on it, and something I would really like to play coming off the 200-day moving average, and I'll probably go play it personally, but as far as a challenge signal, it just simply is not, as it sits right here. So a couple factors. You can see the stochastics 39.1 well below 50. You can see the stock trading below a downward sloping 20-day moving average. We just typically do not get signals when those things happen, and so nothing to go after there for the challenge here today. We did see something a little bit different in the market today, and I mentioned it on a note that I sent out this morning. But if we zoom into S&P futures this morning, you can see that we had this volume candle here of 20K right here. Now, what does that do? Well, there's nothing magical about, it's 20K, so this has to happen. But there is a very strong tendency, and it works on the upside and the downside, right? And we normally are talking about it on the downside. Market sliding, gets 20K, okay, puts the bottom in for the day. Here we had 20K on the upside. Market opened up, ripped higher, right? First day of a new month, we have funds, having to put money in and saying, we had a nice dip Friday. We'll just send it in right away on Monday. And all that money hit, and then massive volume. And what's it mean? It means the tops are in for the day, meaning we're probably not closing above that level. Yeah, we could drift above it, and we did, and oftentimes we do. But to see the market close above that level, very unusual, and you can see that right now we are, significantly below that level by about 13 points right now. On the S&P. So we saw that come in today. I do think we're going to have more of these. With the way the market metrics are, we're going to have more kind of topping volume, bottoming volumes, on a day-to-day basis that do provide, day trade opportunities there for them. But, again, they're not going to provide, real challenge opportunities, as they sit here. But, if we come in and just pull up the S&P, you can kind of see what this looks like. Just a little inside day. There's not a lot of consistency as far as what this day means. When you look at these types of days in the market, it's coin flip as far as what's going to happen afterwards based on that candle pattern. So it's just not a very it is a rather common candle pattern, but it's not something that has a lot of tell to it. There it is one that I think Friday's action is one that matters a lot more. We see the market break above Friday's highs. We could revisit brand new highs on the market. We see the lows from Friday broken. We could see, a quick tumble down here to the 307, 310 area on the SPY. And, you say, shouldn't we be able to figure out whether it's going to do it now? Well, Some of that's going to depend on, how the coronavirus continues to, propagate around the world, and what governments do. Today the market didn't gap down 50 points because China came out and did what? Now, China pumped a huge amount of money into the economy to, try to keep things held up. If we look at the Shanghai Composite here today, let's see, is that it? No, let's see if it'll find it here for me. No. All right, my apologies. It's slipping my mind right here. The chart symbol, therefore it'll come back to me here in a moment. But the Shanghai Composite last night was down almost 8% and kind of stayed there most of the night. And one of the reasons that it did is simply because there was not, a lot of stocks were already limit down. They had gone down as much as they can go down on a given day with the market restrictions, and they stopped letting it fall. So we do see China, down here pretty big. You'll notice the FXI isn't down all that big, right? Well, the FXI is traded in the U.S. and it has been falling while the Chinese market has been closed for the Lunar New Year here. This is driving me nuts that I can't find the ticker symbol here for the Shanghai Composite, and that's not going to help. So we'll move on. It'll come to me here. But anyway, that's what we have going on. And so as far as what next direction of the market, what do we know? Well, we know what the metrics are, right? And the metrics are still bearish. They were bearish on Thursday's bounce. They're bearish on today's bounce. We're not seeing the metric shift on these bounces here so far. You can even see the bullish percent index. It's down today, right? So it's one of those where it tells us the volatility is going to remain elevated. It tells you selling rallies is going to be, normally a little more effective from an option standpoint than buying dips, because when you're buying dips, you're basically paying extra premium. When you're selling rallies, that extra premium is out. Some of it at least is out. I looked this morning. There wasn't a lot of excess premium out of some things. There were a few options that were just, oh my goodness. But, we're going to continue to see that. And we're going to continue to see chop and dice and dance around. Now, will it emerge into a major trend, or will it simply be a topping pattern, right? And we talked back here on this day, right, when the market made this reversal, and we've been talking that, hey, on this rally, something obvious is going to happen to say, hey, top is in. We had something obvious happen on that day, okay? We had something obvious come in, and now is it, okay, downside trend coming, or are we going to create a topping pattern with a downside trend to follow? And this is just one where the verdict is still out, right? The verdict is still out. It is one where I would not be surprised to see it go back and test new highs and then roll over, right? And this be part of that process. So there's a lot of different things that could happen. Some of the economic data that we get here for February is going to dictate. The way the coronavirus happens is going to dictate. And then earnings season is going to dictate. And earnings season is very interesting right now. There are some just really interesting things when we look at earnings season. Just under half of the companies have reported. So we have enough data that we can extrapolate and say this is what the earnings season is going to look like when it's all said and done. And there are some very interesting things. I have some stuff written on this screen right now. We'll come back to it. But there are a couple things that I want to look at. What is the earnings and revenue quality, right, here for earnings? Right? We've had some really good quality revenue growth of late. We've had some really low quality earnings growth of late. In fact, we're sitting with now earnings contraction for 3 quarters in a row. And this quarter could be the fourth, right? What about profit margins, right? Profit margins. A lot of time profit margins, if they're continuing to rise, we see markets continue to rise. If they start to falter, we see markets start to falter. And so, what do those look like? And then what are projections going forward? Well, let me bring up this image here. Let's see. Where do I have that? My apologies. Here we go. All right. So this is the S&P earnings growth. Okay. And my question is what's the earnings quality here? Right? Energy looks nasty, right? And we expect it, right? A big drop. Consumer discretionary, that's a big drop. Materials, a big drop. Industrials, right? The earnings growth is negative for the S&P 500. And the earnings growth is being carried by utilities, which we still have a lot to hear from. This utilities number is a little skewed. But we've heard from all the financials. We've heard from a lot of the major healthcare. But, it's financial, healthcare, communications, utilities that have the earnings growth. The earnings quality is very poor. It is extremely poor. The earnings growth is not happening in the more growth-centric areas of the market. When you go to information technology, which gets some of the tech, it's kind of divided between comm services and infotech here. But we have some of it here on the comm services. Infotech is negative. But in all, the earnings quality is simply not very good right now. It is a rather blah and a rather bearish-looking picture. In fact, bears could make a good argument from this to say, hey, this earnings quality is terrible. And, but this isn't anything new. This has been this way the last several quarters. What about revenue? You've heard me say many times, it's revenues that matter. It's revenues that matter when it comes to what the market is trading on. It's not valuations. It's not earnings growth. It is revenue growth. And take a look. There's some pretty big numbers here. Healthcare, 10%. Double-digit growth. Massive. Utilities, double-digit growth. Still a lot to report. Communication services, info technology, so our tech area, right? Has some really good growth. Consumer staples, 3% growth. S&P, revenue growth of just under, 3%. It's actually 3.1% right now. But while we have negative earnings in the S&P, we have positive revenue growth. You see the financials, they're still growing. Industrials, this is where we see the negative. Industrials, energy, and materials. And this can all be accounted for by the name China, right? My terrible mouse, my mouse spelling there. But the revenue quality is greater than the earnings quality, even though it's still not all that great, right? Okay, we have revenue growth. We don't have earnings growth. The last time we had 4 quarters of earnings contraction, like we are set to have now, was back in 2015, right? And let me kind of show you what this looks like here. But it was back in 2015 and into 2016, right here. So middle of the year, right here. This is where it started, and this is where it picked back up. The market really just didn't go anywhere during that time. Very, very flat. Well, right now we are on the verge of the 4th quarter in a row of no earnings growth, and you could see that the market has still gone up. Why? Because we've had revenue growth. Back here, we didn't have revenue growth. Back here, we had a revenue recession. We're not having a revenue recession right here. Yeah, is revenue growth this quarter below the 5-year average? It is. 3.5% revenue growth is the 5-year average. It's at 3.1% right now. So the bears can look at that and say, hey, you know what? This is a low-quality earnings, right? And I think that's what we kind of have to call it. It's a relatively low quality earnings period right here, right now, in what we are seeing. Profit margins, they're set for their 4th straight quarter of declines as well, which only adds to that. Look, the earnings quality is pretty bad. It's just a low quality earnings that we are seeing right now. You say, well, all right, if the earnings quality is so low, why aren't we seeing a massive pullback? I mean, it has taken the coronavirus, a global pandemic, to create a pullback. Why aren't we seeing more of a pullback if the earnings quality is so low? Well, it has a lot to do with this, with the projections going forward. Next quarter, 3.7% growth. We've talked about individual stocks going into an easier comparable season because they've had some rough quarters over the last 3-4 quarters. And now some of the comparables getting easier. Well, that's happening for the market as a whole. When the bears are looking and saying, well, this market, the earnings growth is terrible, blah, 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 the earnings quality is on the decline, great. That's all well and good. We can see that. But the projections for next quarter are pretty strong. They're projecting a return to growth. We get a return to growth, what happens? Yeah, stocks are cheap, right? Yes, I know the forward PE on stocks is higher than it's been since 2002. We kind of bashed the valuation argument last week and just kind of how ridiculous it is with the substitution effects. But when you look at, hey, do you want to be caught selling right now when the projections going forward are for double-digit earnings growth by this time next year? No, you don't, because historically when we see these kind of numbers, we can see the market up 30, 40, 50%. Market can grow in a very big way with these types of numbers. And so it keeps the bears at bay a little bit, right? And so bottom line, what do I take from this earnings season? Yeah, we have individual companies and all of that, right? But this earnings season tells me one thing. It tells me that the economic data that we see here in February and March may be the most important pieces of economic data that we see or have seen in the last 3 years. Because if that data does not improve, if that data weakens, these numbers are not going to get hit. These numbers are going to have to come down. If these estimates come down, given what the earnings quality has been, it is going to catalyze some major selling out there. If the earnings data is solid and strong and reinforces these numbers, there's a long way for this market to go up. And so this is just one where I believe the earnings season tells us the importance of the economic data that is coming, and the importance of that data to the markets. And that's outside of looking at each individual stock. When I look at the aggregate, to me that's the story, right? It's not a matter of, well, do we break down what the margins look like overall, and do we break down, well, the revenues are a little lower, a little higher, or the earnings quality is this. It's basically one where we look and go, okay, this is something where the data matters. Now, speaking of data, we got the ISM data this morning. Okay, January 2020 manufacturing ISM, here that was released this morning, and the number came in at 50.9. This has been a contracting number, and it came in at 50.9. That's now expansion. Above 50 is expansion. New orders went from contracting to expanding. Production went from contracting to expanding. Employment still contracting, but improved. We saw deliveries expand. We saw inventory contract, which is, one of those things you could say is a positive. Customer inventories are still very low. They're not holding a lot on their shelf. We saw prices rise, which is a big positive. We saw export orders rise. We saw import orders rise. This is one of the best PMI numbers or ISM numbers that we could have expected to see and have expected to see there. It is a really solid number, and it's one of the numbers that contributed to this just massive rise that we saw, come in this morning, because the data, it was released early, and they're doing some things to fix that. But, it created a nice jolt and a big positive here And if we continue to see data improve the way we saw this ISM manufacturing number improve, the a correction in the market is going to be very short lived. It is not going to give the dip buyers a massive dip to really get involved with if we see the data continue to improve like what we saw it do here this morning. So, when I look at this earnings season, you know where I stand with certain companies and Starbucks and those types of things. We have a lot of companies left to report. But yeah, there are companies out there where maybe the best is already priced in. Maybe with Apple, maybe with Microsoft, some of the best is priced in. Maybe even with Intel, some of the best is priced in. But when you look at things like Chipotle, Starbucks, even the banks, Bank of America, J.P. Morgan, it's tough to argue the best is already priced in. And if we continue to see the data improve, the market has a long way to go. It does have a long way to rise, and I know that's, it's already gone up a bunch. It can't go up anymore, right? That whole mentality that traders have, and you hear on TV, but that's just not how markets work, right? You look at it historically, that's just not how markets work, and it's one where we could see significant upside. Is there some vulnerability to the downside? Yeah, there is. Especially if we see the data weaken. And the ISM number was only one piece of data. We start to see the data weaken, to see the market have a 10, 15, even 20% pullback would not be too startling given everything else that we see out there. All right. Thanks for hopping on. Have yourselves a fantastic day. I'll be back on with you here tomorrow morning, and we'll talk to you then. Take care.